is Emma. I'm going to be the moderator for this session. We're excited to have you all. And with that, I'm going to pass it off to Shemek and Peter to get us started.
Awesome. Thanks so much, Emma, and welcome everybody. Thank you for joining us this afternoon, evening, morning, wherever you're located. So my name is Shemek. I'm one of the founders here at Capchase and COO. And we're the leading provider of non-dilutive financing for SaaS and recurring revenue companies. Super excited to be with you here today. So I'm a huge fan of startups. I'm a huge fan of finance as well. I love combining these two things together. So it sounds like we're going to have a fun discussion today. And I'm thrilled to be joined today by Peter Frank, who's the managing director of I-80 Group, who is one of our key capital providers at Capchase and a debt fund that has lent hundreds and hundreds of millions of dollars to a variety of top startups, including Capchase, Open Door, Divvy, and many others. And hopefully we'll have a good chat. So thank you for joining us, Peter.
Absolutely. Really appreciate the time and having me on, Shemek. For those of you who I haven't met before, my name is Peter Frank. As Shemek mentioned, I'm a managing director on the investment team at I-80 Group. I-80 Group is an asset-based lender, really providing structured financing, credit facilities to companies that have capital-intensive business models. Shemek's a great example, really working largely with fintech and prop tech companies that are venture-backed and tech-enabled, and exciting to dig in more here.
Awesome. Thanks, Peter. So the way we structured the next 55 minutes is we're going to have a quick discussion with Peter about the different financing asset classes, what we're seeing in the market, and afterwards we would love to take your questions and open it up. So maybe maybe a good place to start is giving folks an idea of what we've been through at Capchase in our financing journey, and also what we do with our customers in terms of how we work with folks. So very quickly, we're a post-Series B business. We're backed by VCs. We've raised 3 rounds of financing since starting in mid 2020. We started by raising a round from angels and VCs, and since we're preaching a non-dilutive message, we very quickly decided to make sure that the funds that we're giving out to our customers right now come not from equity, but actually from providers such as I-80. So then we raised the debt round from I-80 in late 2020. And frankly, raising capital from Peter and I-80 was critical. It allowed us to secure a big credit line, which we're going to talk about later, and today, serving thousands of SaaS companies globally and making available billions of dollars to these businesses. As a reminder, we work across North America and Europe with SaaS and recurring revenue companies, and we're here to help folks grow their businesses faster through not only capital but also insights, so benchmarks, our analytics tool, community support. And we do it by bringing future expected cash flows to the present. So we're allowing you to tap into what you're expecting in the future today, and using that as capital to fuel your growth. But enough about Capchase. The reality is we're only a small part of a very big and diverse funding ecosystem, and we're one of the many companies that I-80 work with. How about you, Peter? How do you guys work at I-80? What types of companies do you seek to partner with?
Absolutely. So similar to the way Capchase works with SaaS companies and technology-backed recurring revenue companies, we work with companies that, in order to scale their business, have to scale their balance sheet. So companies that are either really asset intensive, really capital intensive. Right, Capchase, obviously, you guys as a partner of us is a great use case. In order to make advances against the underlying revenue, SaaS revenue, you have to have that capital. So as you mentioned, using equity capital to make those advances would be perpetually dilutive to your founders and your investors. So finding the right risk bucket of capital that isn't equity finance, that's more structured, that comes with more of a credit structure, is a great use case, is how we scale with businesses. So essentially, as you're scaling your balance sheet, we're scaling, right, the facility alongside yours. So in the case that we do a $100 million facility with Capchase, right, we're not writing a check on day one. We're scaling the actual credit facility as you scale your disbursements to your underlying borrowers and so forth. So as a group making advances, that's a great use case. We also work with companies in the prop tech ecosystem that are buying houses or buying commercial real estate. We also work quite a bit with what we would call diversified small business roll-up strategies, things like in the on occasions, Amazon FBA, in other cases, Shopify roll-ups or roll-ups of applications or roll-ups of very small businesses. So those are all sort of core use cases of sort of the capital intensive models that we partner with.
Got it. That's super helpful. And one thing you did mention, which worked particularly well in Capchase partnering with IAT, is the scalability of the solution, right? It's sort of similar to the way we work with SaaS founders, SaaS CFOs, SaaS companies. So we can get started pretty early, right? The requirements for us would be the company has recurring revenue, ARR starting at 250K plus. We have clients with 100 million plus in ARR, at least 6 months of revenue generating history, and somewhere between 3 to 6 months of runway at a minimum. And then over time, obviously, as we get to know each other, we use at your use case, right? So are you trying to fund customer acquisition costs? Are you trying to invest in a new market, hire engineers, etc.? Are you trying to extend runway? We look at things like unit economics, which is ultimately how you generate value from every dollar of spend, maturity of operations, and all of that we boil into what we call CAP score, which helps us determine how to right size the Capchase financing, our advances to each customer. So we try to do it pretty quickly. So we typically turn around in 24 or 48 hours after we receive all the data. And that's within the SaaS space. And curious how it works for you, Peter, at IAT. Your advances or your lines are quite a bit bigger. So I'd love to hear about your process and how you evaluate folks and what should people expect in terms of funding.
Yeah, absolutely. And from kind of the perspective of kind of what criteria and what benchmarks are we looking at, and what do we want to see before we actually do start partnering with a company? There's you can sort of bifurcate it into two buckets. There's kind of core equity-like metrics that we look at and core debt-like metrics. And when I say equity-like metrics, I mean kind of the things that more of a venture capitalist would look at during the underwriting process rather than a typical credit provider. And that's because we're working with companies at a really early stage. I'd say in some cases, we'll work with companies as they're in the process of going to market, or as if, I think in the case of Capchase, as they had recently gone to market, they developed some sense of product market fit, and they have kind of a credible visibility into 30 to $100 million of growth over the following 12 to 24 months. I think that last point is really important. We can underwrite the actual credit and the structure based on how the product is designed. But a key thing is having key distribution channels, having a really realistic approach to going to market and to finding customers. That can be through partnerships, that can be through paid acquisition on your typical paid spend mediums. But that element of we're going to work with a really early stage company, so we need to know that we're actually, right, they're going to be able to deploy capital and they're going to be able to build a diversified asset base, right, which is ultimately what we're underwriting. And I think that is, right, for the same reason that venture capitalist jobs are hard. That's also can be one of the challenging parts of the credit side. And on the credit metrics, I think we're looking at a lot of the same things that you are. We're looking at the underlying unit economics. What are their gross margins? What are their cost of acquisitions, their lifetime customer value? How effective has the management team been to date? Do they have relevant experience? Do they have the ability to scale this business? From a process point of view, it's quite a bit longer, just given that because we are a structured credit facility and the scale and size of our facilities can be anywhere from 30 to 100 million or $200 million. There's quite a bit of legal structure and documentation. So I'd say to provide a company terms, it typically takes about 2 weeks, so a relatively quick process. And then once we have a non-binding letter of intent in place, which takes typically a week or two above that in terms of negotiation and customizing the facility to make it work for the company, it's about a 2 to 3 month actual documentation process. So I think it's fair to say it's an all-in time frame of about 3 months from starting due diligence to the company actually drawing on the facility.
Super helpful. And when Peter says they get involved early, the conversations can start very early, right? I think we had our first chat right after we incorporated, right, before we even raised equity, and it feels like both types of funding can come together, right? So somebody can raise a seed round or a Series A, whatever that is, and then tag on this types of financing. Curious, Peter, in your view, how do VCs and the equity investors look at what you guys provide, and maybe also like how are you different to venture debt, which is something that folks probably would be familiar with as well?
Yeah, absolutely. It's a great question. And I think very similar to Capchase, but right, with a very different use case. VCs are some of our best partners. I'd say they're the biggest channel of deal flow for us, and definitely the highest quality channel as well, especially at that early stage. They're a much better touch point for being a good indicator of, is this company going to be a fit, rather than sort of a broker network the way you would see at a much later stage. But VCs see us as very complementary. At the end of the day, the companies we work with are capital intensive businesses, and typically VCs do not want their money going towards lower ROI activity that's building the balance sheet. They want to be focused on hiring, on R&D, on kind of not so much assets that might generate a 20 to 30% return, and much more on building enterprise value that's going to, at an early stage, be 100% ROI activity. So in that sense, I think it's very complementary, and in a lot of, right, the less money companies are putting towards, right, their growing their balance sheet, the more they're putting towards, right, the highest and best use cases. But I mean, for Capchase, Shemek, would you say it's pretty similar from a value proposition point of view?
Yeah, I think that's a great point. I think we certainly distinguish also between the role VC capital plays, and frankly, it is expensive capital because you're giving up your business, where we think VC dollars should be used for kind of your best. So new R&D, maybe a market entry, something which has some probability of succeeding, but maybe not necessarily. R&D hires, which have a payback period of a few years often on the engineering side. I think where we can come in and we can be helpful and productive is on the predictable side of things. So if you're trying to, if you're thinking through your customer acquisition spend, what is marketing or growing your sales force, something where, your main engine is humming, you're just throwing more fuel at the fire. I would say that's where our capital performs pretty well, and ultimately it's about getting the right mix of capital. So we more than half of the companies that we work with are VC backed, We also work with a ton of bootstrappers, so folks which impressively scale the business to many millions, often tens of millions of revenue, and at some point dip in, below the red line to accelerate growth in a responsible fashion. So it all really depends on ultimately what you're trying to do. Yeah, anything to add, Peter?
Summarized it well. I'd say, us compared to sort of a venture capital solution, I think or a venture debt solution, I think it's interesting because it's different for you guys as a pure venture debt solution. Whereas venture debt, you're typically just underwriting how much money does the company have now, how much are they going to burn between today and their next round, and what's the probability that the company will make the next round. And that leads to, for an early stage company, a much lower quantum of capital. Whereas we're looking at their underlying asset base and we're saying, what would it take for them to scale what their balance sheet and their asset base to $50 million? And what's the probability they're going to be able to do that with the capital they have raised and their existing strategy? And it seems like it's a bit of a different calculus for Capchase too, in that you're not just kind of myopically focused on cash burn and their current cash position.
That's right. It really is about the recurring revenue base, the retention, the margin. Ultimately, we're betting that there is a ton of cash flow that's coming back to the business from the revenue generating activity today, and that's what we're betting on. Curious, I'm sure as part of your selection process, you as we have done, with you guys, we've gone through a round of calls, and you meet different management teams. What in your opinion makes a strong management team, somebody they're excited to work with? How would you characterize it?
Yeah, it's a good question, and it's something we spend a lot of time thinking, because we do work with companies that are at the early stage or at the seed and the Series A stage company, and a lot of what you're focused on you're very conscious of the fact that not everything is going to go perfectly, not everything is going to go correctly. Is this the type of management team that has the experience and the ability to figure things out as they go to some extent, and to evolve as kind of their understanding of their own product market fit evolves, and as their go-to-market strategy changes from maybe what they thought it was initially. And there's really no single archetype or category. I think it is sort of holistic in terms of what the company, what the market is, what the underlying product is. I think there are some common just denominators, common characteristics. I think you guys are actually a really good example in that you were starting essentially a lending business, and I don't think anyone on your founding team necessarily had worked for a lender before, right? Yet you guys have been tremendously effective, and I think that's a big part of that is you were extremely focused on who the underlying customer was, on what some of the issues were that SaaS companies were facing, and how basically the recurring revenue has been largely kind of underutilized, undermonetized, underleveraged to date. So I think that's a great example of, you don't need to have 10 to 15 years of management team experience in a specific domain. You can have a really nuanced understanding of the underlying problem and how you want to solve it. I think other ones is just a group that can prioritize, that knows the 3 or 4 things that they need to focus on and that they want, and it can be pragmatic and commercial about making trade-offs to get those things done. I think you guys are good examples of both of those.
Thank you. And I think it always needs to be coupled, end of the day, with a flexible partner, which I think we've found in IAT. So to give folks an example, we've been experimenting, particularly in the early days, with what the product ended up looking like, right? So we actually started working with individual contracts and funding against individual contracts, accelerating that revenue. Today, it's taken a different shape and form based on customer feedback. So we're offering a percentage of ARR upfront and then scaling of the business as it grows. And that took some iterations, and and IIT were a helpful partner in it. I think the other aspect, obviously, of any I think management team that you want to bag is sort of the agility and reacting to the changing macro environment, and I think particularly companies with balance sheets need to be quite on the lookout. As you think about, there was talk about, are we going to have recession? Are we not going to have recession? Is it going to be soft, hard, and all that? But how are you thinking about, businesses preparing for the next 12, 24 months and the current macro?
Absolutely. And I think that is kind of the $1 million question, so to speak. And I think a lot of it hinges on, right, what are VCs looking for, right? And one of the more dramatic elements we've seen is, right, just a pullback from VC and kind of a reconception of what does a company, right, the trade-off a company makes between growth and burn, and how they prepare, right, what they should have from a cash utilization perspective, how they should be able to think about their own runway. And I think it's a moving target, and it's something we think about a lot. One of the things that makes it tricky is it's something that I think the venture capital community is still, right, figuring out within itself as well, and that the early stage, right, venture capital is trying to figure out what the growth stage venture capital is looking for, and the growth stage venture capital is trying to figure out what the late stage venture capital is looking for, and they're trying to figure out, right, what the public markets are looking for. So I do think it is a bit of a moving target, and it's evolving and it's changing. But I think it's safe to say that companies that are thinking financially about cash management in more of an efficient way, that focus a lot on revenue quality, not just growth, right? So is revenue truly recurring? What do metrics like churn look at? How long are they able to monetize their underlying customers, and how can they continue to provide them value? And I think there is a lot of we do it with very different companies, and we do it in a very different way, but we're both really just looking at what is the underlying quality of revenue, right? And when it's loans or advances, it kind of, the nomenclature changes. It becomes more kind of days past due and charge-offs and defaults, but ultimately we're looking at churn the same way I think you guys are, and being really kind of diligent in terms of what is revenue quality. Are you able to generate really high quality revenue, but also able to scale it in a capital efficient way with appropriate customer acquisition costs, where you're able to show at least directionally credibility to move towards profitability. What I'm curious though, you guys see a huge part of the market, especially the kind of B2B SaaS, which is a very venture capital backed. How have you seen founder approaches change? Do you think that founder approaches have changed as quickly as we hear about VCs kind of invoking discipline on their underlying companies?
Yeah, that's obviously the elephant in the room, and I think we are as a company that's trying to provide a service to extend the runway. We look at runway very, very closely, calculate in different ways, and often actually try to offer additional insights to the founders based on how we do it. It's interesting. I do think that VC-backed companies with a board member or two from an institutional investor have certainly all been receiving calls asking them to prepare themselves for not having to raise for another 12, 18, 24 months if possible. What that implied is again, abandoning growth at all costs, making sure that metrics like LTV CAC stay in check, and often what we, for example, track very closely, which is how far off that golden rule of 40 a given company falls. It is interesting as that is also evolving with the times. So for example, right now you would argue that founders do not necessarily need to be so laser focused, particularly in the early stages at, seed, Series A, at trying to hit that rule if the growth needs to slow down a little bit faster than the burn, but if that means extending runway dramatically, right? So I think some conceptions of what like good and solid looks like in very healthy times might be a little bit different when times change, and I do think that board members recognize it. I do think that it's good to stay in very close contact with the board and advisors these days. So, whether it's weekly, bi-weekly, monthly catch-ups, and iterating on the plans, kind of over communicating why am I making certain changes? Why am I, cutting a forecast or changing a forecast in a specific way? And at the same time, you do need to keep a company in a good enough shape to be able to go out to the market and if need be raise a safe note or raise a convertible and as a contingency, right? So again, just speaks to the general health of the metrics that the companies need to keep.
You guys are oftentimes, I'm sure, the first debt capital. It's similar to us in a different market, but the first debt capital into these companies. How should a SaaS company that has, something in the 3 to 5 million ARR range that's growing, how should they think about the amount of debt that they can bring onto the business, right? We talk a lot about kind of the need for more non-dilutive financing, but how do you guys usually talk to companies about being prudent and not over leveraging as well?
I think that's an excellent question, particularly as I think many founders are trying to, frankly, hoard cash because, who knows what's coming, and that's kind of like the assumption that people need to have. But I do think that, if you're taking funding from somebody, you will be required to pay it back, right? Stating the obvious. So it is important to look very closely at cash flow forecasting and seeing, okay, after all the repayments, after kind of paying for the growth I'm hoping to generate in the future, and paying for OPEX and COGS, etc., how much is left over. And if I am going to continue to burn even like heavily, what optionality do I have to turning profitable, turning cash flow positive, and then, controlling your own destiny, right? So let's say for a $5 million ARR business, we typically size the line somewhere between 20 to 60%, depending on the metrics, which we believe is a comfortable level to be paid back over what is 12 or 24 month period. Again, depending on the situation of the business. We also caution founders against stacking different providers, and I think many providers will have clauses that prohibit that in the first place, but it is often relatively easy to get financing from various providers, and then struggle to keep up with repayments. So it is about being responsible.
Yeah, I think one of the interesting things that Capchase and you guys have been very cognizant of is that running an early stage SaaS, even if it's a very technologically sophisticated company, is hard, and it's hard to have kind of really good data. And it seems like you guys have been very focused on creating, in addition just to your capital product, additional products and services to actually drive more sophistication with underlying companies. I think it would be helpful. I think the analytics product specifically, right, probably goes a long way towards helping companies actually understand their own businesses.
That's right. That's exactly right. And good you bring it up. So partly related to what we discussed, just minutes ago around, how much leverage is the right amount of leverage. We, first of all, try to take the data that we receive from the companies. So it's a mix of accounting, banking data, where we look at every transaction and try and glean insights, as well as billing data, so your Stripe, Recurly or whatever, and display it back. And not only talk about, gross dollar, net dollar, and logo churn, which I think a lot of folks do, but help people think through, contingency planning on things like runway. So at what level of burn, when do I run out of money, and what are my options, and ultimately, selfishly as a lender that helps to de-risk our business, because what we want to do, and our part of our big value prop, is helping folks focus on coming up with amazing products and selling them in the marketplace, not necessarily being extremely focused on finances, which we're hoping to help automate. So if we can help them make better capital allocation decisions, that's the additional time that they can spend on building the business. So we provide the analytics product. We also now provide a ton of benchmarks across the different stages of development, from seed stage through to tens and hundreds of millions of ARR. What does a solid gross margin look like? How should retention behave? What percentile of companies have 6-12 months of runway? A ton of these things, obviously, companies keep private, and we aggregate it based on an anonymized basis, and hope that it's helpful for everybody that can read it.
Yeah, that's great.
So with that, I'd love to, unless Peter, you'd like to add anything else, I'd love to open it up to questions. And I think, we have the first question in the chat, which is, how do you know when it's time to raise capital? Is it revenue, market cap, et cetera? So, Peter, what's your take on it?
Yeah, absolutely. I think for the types of businesses that we work with, it's somewhat embedded in the business model. So I think it's something that you realize really early. The type of, call it warehouse financing or capital facility that we're typically providing is inherent to a company being able to actually scale outside, like beyond the seed stage. So I think if it is a balance sheet intensive business, if you're looking at your business model and the way to scale it is by acquiring assets and it's very capital intensive, then it's going to be a natural fit for our type of product.
Yeah, I think, for us, clearly, having revenue generating history and at least a few $100K of ARR and decent growth tailwind is important, as well as runway. And we're hoping to multiply that runway. So, because, we get repaid not in many years, but typically over 12 to 18, 24 months, it is important that company has momentum. And often as we see back, although that's not a requirement. So we have a question around how expensive it is to diligence and paper some of these facilities. I think for us, we make it pretty cheap. We have a standard agreement that we sign with folks, which is just a few pages, and the diligence is pretty rapid and very automated. And then, over time, we remain connected to data sources and hope to continue to offer more availability to founders. Obviously, Peter, you're dealing with bigger dollar amounts. What does that look like for IAD?
Yeah, and because of that, it's a highly structured product. So there's quite a bit of both legal and resource intensity. I mean, kind of people's time, legal time, third-party diligence is. So I think it's not unusual that for call it a $50 to $100 million facility, it can be in the $100,000 to $200,000 range, which I think for most founders that are managing their burn it probably comes with some sticker shock. But when you think of it as, call it 10 basis points, it's probably consistent with on a relative basis with what you would expect from other types of facilities or term fundings. But yeah, certainly the way that Capchase has created your underwriting process and your technology tools, it's extremely efficient from that sense for the types of companies that you guys are working with.
Awesome. So Lee is asking about what's next for Capchase. Many exciting things. I think we've just rolled off a few announcements around, rollout of the analytics product, benchmarking, and partnering with Stripe, where, in the Stripe app, we can now disperse our funding. I think, what's important to highlight is we will be staying focused on the SaaS vertical. So it's actually not about moving to other verticals for us. It's going deeper. So what is the additional tooling? What are the additional insights that we can offer to SaaS founders, CFOs, and these businesses as they scale? Be it, on the AP side, AR side, on the payment side, simplifying the financing and the finance stack for these businesses as a whole. From a geo perspective, we are already present in North America and many European countries, and I think it's about getting depth in those markets. I think we have a question on bootstrappers. So if my business is breaking even, what do you need from a balance sheet perspective for your platforms to work with me? Look, I think first of all, congrats if you've bootstrapped and you break even / are profitable. That's an achievement in and of itself. I think there's depending on the burn that you're dipping into, I think a few at least 3 to 6 months of runway based on that calculation would be required, which hopefully we'll be able to turn into 12 or 18 over time. And I do think that even if we are offering someone 50, 60% of ARR, tapping into that line over time, if you're bootstrapping, growing at a more measured pace, is probably something that we would advise rather than taking a lump sum up front. So that's what we call programmatic funding at Capchase, which is every month drawing only as much as you need and not more, ideally. But what do you think, Peter? You're also looking at different types of companies.
It's a good question. I think there are other variables that are important to consider. Right, if you're profitable and you're doing $100,000 of annual revenue, having a 3 months runway, considering that you probably have significant revenue concentration, you probably don't have a ton of margin for error, right? Whereas a company that's doing 5 to 10 million ARR probably can be a little bit more efficient in how you manage cash. But I think it's a part of it is just about giving yourself an appropriate margin for error. I think, being consistently break even or profitable, that's tremendous, and you've already de-risked your business quite a bit. But if there is some volatility in your revenue, if there, kind of what we were talking about earlier, your revenue quality, there's some vulnerability there. Only having, call it 2 or 3 months of cash at an early stage, even if you are profitable, could introduce risk to the business. And I think it probably does make sense to explore alternatives for building a little bit of a bigger balance sheet in that sense.
And a somewhat related question, which is on, top strategies to extend runway. Obviously, as a company that exists to extend runway, we like to say that one of these strategies should be Capchase. And I think, specifically how that unravels, it really boils down to unit economics. So with every dollar of spend, can you generate $2, $3, $4, $5 of contribution margin? We're not talking revenue, but actual kind of value add, so that if you're drawing funding from us over the next 6, 12, 24 months, however long it is, at the end of that period, have you generated multiples of the value of the financing that you took? Ultimately, we care that the companies we work with deploy the funding in a productive way. And I think that goes for any dollar that you're spending. I think other things that come to mind would be obviously looking at the cost base. I think every company out there has probably a little bit of spend that they can trim Sometimes it's a little bit more, sometimes a little bit less. The great thing about SaaS is you're dealing with pretty high gross margins and a good retention of revenue. So that makes it a little bit easier to maneuver than some other business models. But what's your sense, Peter?
Yeah, I think that's right. I think it's sort of a little bit challenging to say on a general level, not to answer with a non-answer, but yeah, I think, right, examining the cost structure and unit margins, looking at where your highest value customers and revenue are, ways you can improve monetization of them, right? Cross-selling or selling more into your existing customer base is oftentimes very efficient and, right, will improve margins and cash burn as well.
Awesome. We do have another question on what's essential for startup leadership aside from creators and then attorney. And by creators, I presume it's founders. In at least in our case, and Peter is looking at a ton of companies as well. It was actually additions of folks who had experience in building a lending business, right? Which is where we are today. So it meant adding a very strong head of finance early on. It meant tapping in for help with capital markets and raising the types of capital that IAT offers, as well as being buttoned up on risk and automating a lot of the underwriting. So I think depending on the business that's being built, and obviously go-to-market is another extremely important angle, although often founders end up being the first sellers. So it really depends on the type of business you're building. That's what it looked like for us, at least.
Yeah, and kind of in addition to what we said earlier is, I think you just made a great point, is that a team that's a leadership team and a founding team that's allocating resources appropriately. So as you grow, right, you're bringing on a head of capital markets, you're bringing on a head of finance. The key kind of core founding and leadership team isn't trying to do everything. They can hire really effectively, and they can learn really quickly because we talked about a little bit before. You're not going to get everything right, and that's fine. The best companies probably don't. They just figure out ways to iterate and problem solve more efficiently.
Awesome. Happy folks to unmute themselves, and if you want to ask a question directly as well. Yeah, lending in Europe. Maybe Peter, what's your sense on how the market's different to the US? Rates, terms, and any other differences.
Yeah, it's a good question, and I think it depends to some extent. It'll be interesting to hear your kind of operational perspective on how you think, right, how that changes as well. But I would say in general, right, rates are and historically have been lower in Europe. That said, I think our type of financing product is more common in the US. It's just in general more of a competitive market at the earlier stages. So there's also, it's to some extent offset by more greater scarcity of capital solutions for earlier stage startups. But on the whole, I would say that rates are lower and expectations around how much you should be paying for debt are lower as well. So I think it's just a adoption of non-dilutive financing, both at least at our level, is higher there, and there's funds like ours are just less prevalent.
I think I can offer a quick kind of operating perspective, which is while amazing SaaS companies exist both in Europe and the US, for us we had to figure out how we underwrite companies programmatically and with algorithms in both markets. So that meant tapping into different data providers, being able to offer founders the ability to integrate the data that we need to underwrite with a few clicks. So integrating different data sources, and as well as building out the money infrastructure on the back end. but I think, Europe, as a whole, while still probably being a little bit smaller as a market than the US and a little bit less competitive, is probably growing at a faster pace from a slightly smaller base. So we're very excited about it. It's fragmented, and I think the attitudes to taking on leverage probably also differ country by country. But we're incredibly excited to be in Europe. And our DNA is European, so that also helps. Capchase versus venture debt. Very, very quickly, we don't take warrants. We don't have covenants. We don't place a lien or a security over a business. So it's typically an unsecured product. But at the same time, we offer short terms. So that's the trade-off. We do offer way faster process, right? So 24, 48 hours as opposed to often a 1 or 2 month process with a ton of diligence meetings. And I think, scalability is the other aspect. So we're starting at some capacity over time because your business is growing. We grow with you, and ideally, we grow on autopilot, right? So we keep on re-underwriting your business regularly every 30, every 90 days and offering additional capacity. I think with venture debt, you're tapping into some capacity, which remains constant until another re-underwriting a few years down the line. How would you think about Capchase versus venture debt, Peter?
Yeah, I think it's sort of like what are you leveraging, right? What are you basing your financing off of? And I think venture debt is very effective at extending company runway just based on kind of the fact that you have cash on hand, and your burn rate can be forecasted to the next time you would need to raise or to till until you run out of cash, essentially. Whereas I think with something with a Capchase product, really you're leveraging your recurring revenue, right? Your revenue base, and as you scale that up, not wholly independent of burn, you're able to scale up the amount of financing that you're eligible for. And I think it's similar with I-80 in that as you scale your balance sheet, as you scale your asset base, whether you've raised 10 million or 100 million, right? It's not really going to affect the facility that you're looking for.
Mm-hmm. Awesome. We do have a question from Brandon on finance advice for someone just starting a company and working on code. What we very often advise, and that's going to be necessary for any types of financing that you might be looking for, whether raising venture or from providers like Capchase or I-80, is financial statements, right? And if you're not a finance major and you don't want to be spending too much time on it, but you have a little bit of money, I think working with an outsourced CFO who can get your books in a good place is pretty helpful and doesn't need to cost a ton of money. It could be $1,000 a month or even less. So making sure that, your balance sheet, P&L and cash flow forecasts are put together, that, your books balance and so on. That's kind of like step one. And then over time, obviously you're getting into building decks and kind of crafting stories after you put the lines of code. Not sure, Peter, if you have anything to add here.
Yeah, although this is a webinar about non-dilutive financing, right there, I think we both agree there's a place and a time for equity financing, and there are lots of different types of programs and shapes and sizes for equity financing. And I think the stage you're at, when you think about the activities you need to invest in, kind of building the core product, hiring the team, I think that's a good use case for it. While kind of keeping in mind non-dilutive financing as you go to market.
Guys, quick question. I'm sorry that I'm asking it, verbally because it'll take me a while to type it in. First of all, thank you very much for such an amazing chat, very insightful. And so my question is, Peter, unless I'm wrong, you just mentioned that if you have a good understanding of problem and know how to solve and prioritize things to get done to fix it, you don't need to have 10 to 15 years of experience, right? So my question is, do you have some criteria and some, standards that you're looking for in terms of experience in this particular niche or role or whatever in young founders?
Yeah, I think part of it is there are many different ways that management teams can be effective and essentially win their market and go to market effectively. And being for the case of Capchase, being the foremost experts on kind of lending products wasn't necessary because they had such a strong understanding of problems and the capital related issues for SaaS customers and for how to help solve a lot of the payments and financial problems that are just ingrained in the SaaS model. So I do think I think just being a really strong problem solver does go a long way. But you still want to have some angle that you're taking out of the market that differentiates you and that allows you to win.
Okay, I got it. Thank you again.
Awesome. So we did have a question about what's next for Capchase. Peter, what's next for I-80? Where are you guys headed? How are you thinking about the strategy and including as you think about the areas of opportunity and pockets of opportunity?
Yeah, absolutely. I think we're seeing a tremendous amount of innovation and interesting businesses in kind of typical fintech as well as real estate technology and various aggregation strategies. For us, I think it's diversifying the types of companies we work with. We recently announced a raise earlier this year that will allow us to work with what we would call sort of growth stage funds, groups that are at the Capchase stage now, whereas historically our core focus has been on, call it late seed through Series B stage companies. With this new capital, we're going to be able to do larger deals with kind of lower risk and stronger from a balance sheet perspective companies that have a different set of capital needs. So I think allowing ourselves to work or being able to go to market with later stage companies and while maintaining our kind of core focus on the kind of earlier growth stage companies is a big focus of where we are today, and also just keeping in touch with kind of the new products that are coming out, the Capchases of the world circa 2 years ago.
Amazing. Well, we're almost at time, so thank you so much for all your questions. Thank you for being here, first of all, and thank you, Peter, for a super cool chat. I've just dropped in my email in the chat if anybody has questions. Happy to connect directly. Yeah, thanks again. Have a wonderful evening and afternoon.
Likewise, Shemek. I really enjoyed it, and thanks everyone for joining.